Hey everyone, welcome back to the channel. I know many of my videos are heavy on real estate, but we've also discussed the importance of diversifying your portfolio. As an investor, purchasing stocks or even a business can add a significant gain to your bottom line. In fact, here in Florida, you have to be a licensed real estate agent in order to sell a business for someone, even if there is no real estate involved in the transaction. So today's video can be helpful whether you're buying a landscaping business, a restaurant, or just shares in one of them. Today, we're looking at some financial ratios. Understanding these ratios can help you evaluate a company's financial health and promote smarter investment decisions. We'll break down 5 essential types of ratios, explain why they matter, and then show you how to calculate them yourself. So without further ado, let's get started. First up, we have profitability ratios. These ratios assess a company's ability to generate profit relative to its revenue, expenses, or equity. 2 profitability ratios are net profit margin and return on equity. Net profit margin, or NPM, is net income after taxes divided by revenues. Now, this tells you how much every dollar earned turns into profit. Therefore, the higher the margin, the greater the efficiency of the company. Next is return on equity, or ROE. This is calculated as net income after taxes divided by the stockholders' equity. This reveals how effectively a company generates profit from its shareholders' investments. Here's a simple scenario. Imagine a company, Company A, that has a net income of $50,000 and total revenues of $500,000. Using the formula of NPM, that would give us $50,000 divided by $500,000, which equates to 0.1 or 10%. This means Company A earns 10 cents of profit for every dollar of revenue. So why would you use these? Well, I love these ratios when comparing companies in the same industry. It gives you a great snapshot of how efficiently a company manages its costs and generates profit for every dollar of revenue it receives. Next up, let's take a look at liquidity ratios. These measure a company's ability to meet short-term obligations. The key word there is short-term. We're going to talk about another one next that'll address the long-term. 2 crucial liquidity ratios are current ratio and quick ratio. They sound similar, but they're slightly different. Current ratio is current assets divided by current liabilities. Any ratio above 1 means the company can cover its short-term debts, which is always a healthy sign. Quick ratio is current assets minus the inventory divided by current liabilities. This removes inventory from the equation. It's a slightly stricter view of liquidity. For example, suppose Company B has $200,000 in current assets and $150,000 in current liabilities. Using the formula for current ratio, which would make it 200,000 divided by 150,000, we get 1.33. This means Company B has $1.33 in assets for every $1 of liabilities. And lenders and creditors will always use this ratio when looking into a company. They want to ensure a company has enough cash to stay afloat, so this will affect the company's ability to access leverage, which is crucial. Now let's talk about solvency ratios. These assess a company's long-term financial stability and debt management. This is the one that's more of a long-term assessment of the company. 2 major solvency ratios include debt to equity and debt to asset ratios. Debt to equity is total liabilities divided by total equity. Keep in mind, a ratio above 2 may signal excessive debt. Next is debt to asset ratio. You calculate this by doing total liabilities divided by total assets. This ratio also assesses the amount of debt a company has, and a ratio above 0.67 can indicate a risky debt level. Here's a simple scenario. Assume Company C has total liabilities of $300,000 and total equity of $100,000. Using our formula, we'd have $300,000 divided by 100, which equals 3. This would suggest that Company C has a high debt load and may face some financial risks. We're using these types of ratios to assess a company's long-term financial viability. Next, let's talk valuation ratios. These ratios help us determine if a company's stock price is overvalued or undervalued. A common ratio to use is the price to earnings ratio. This takes the market price per share divided by the earnings per share. So a higher ratio might suggest overevaluation, while a lower ratio could indicate an undervalued opportunity. Suppose company D's stock is trading at $50 per share, and its earnings per share are $5. Using our formula, we would discover that investors are willing to pay $10 for every $1 of earning, which would be a reasonable valuation in many industries. We can use this ratio to identify whether or not this company is a good investment opportunity. But I do not mean to imply that this or any of these ratios is the entire picture. But using them all together is a great way to compare opportunities and provide a framework for each company's individual story. Finally, let's cover leverage ratios. These ratios assess how much debt a company is using to finance its operations. One important leverage ratio is times interest earned, which is times interest earned divided by interest expense. A rule of thumb here is that a ratio below 1 may signal trouble. It means that a company isn't generating enough income to cover its interest expenses. Here's an example. Suppose company E has times interest earned of $100,000 and interest expenses of $25,000. Using our formula, $100,000 divided by $25,000 is 4. This indicates company E earns 4 times the amount it needs to cover its interest expense, and this would generally be a healthy margin. Using leverage ratios to evaluate risk, especially in debt-heavy industries, can be a fantastic tool. Now, let's sum everything up. Here's how you can use each ratio we have discussed. We have profitability ratios, which show how well a company turns revenue into profit. We have liquidity ratios, which measure short-term stability. Solvency ratios, which assess long-term financial health. Valuation ratios, which guide investment decisions. And leverage ratios, which evaluate debt risk. Now, whether you're investing, managing a business, or studying finance, mastering these ratios can give you some powerful insights. Now, as you can see, the formulas are very simple, so you can plug them into Excel and create your own evaluation spreadsheet, or you can probably find some online software that will do it for you, and probably even for free. The important thing is that you understand that these numbers are not magic or just pulled from the air. They're simple, but real numbers that anyone can utilize to make a better investment decision. Now, if you found this talk helpful, hit the like button and then subscribe for more real estate and finance tips. Until next time, stay informed and invest wisely.